Airbnb. Let's quickly look at Airbnb's second quarter earnings falling 14%. This is their the stock after they gave some forecasting that was pretty underwhelming. So revenue 20.7 billion, 10% growth. Earnings per share coming in under estimates of 86 cents, was 92 is what the market expected. Adjusted EBITDA, earnings before interest, tax, depreciation, and amortization, 894 million, declined by 9%. But look at their net income dropping by 14%. And funny enough, that's the margin by which the stock dropped as well. And then Disney is raising prices for its streaming packages. They're going to be increasing from about mid-October. So across the board for Disney Plus, which is not in Nigeria, but it's in South Africa and I think Algeria. Very upsetting for me. Hulu and ESPN Plus across the board, all rising. So what does that mean for network television and theaters? All right, China, it looks like it's launching its initial set of internet satellites intending to compete with SpaceX Starlink constellation that's owned by Elon Musk, a system of more than 15,000 low Earth orbit satellites known as Thousand Sails, intended to provide worldwide internet connectivity, according to China. This is from the Chinese Academy of Sciences. It declared that the mission is a perfect success, and we'll see how they do in this growing market. Let's talk to Laura Fisayo-Kolawole, who, of course, is the head of Equities and Alternate Asset Solutions with FBNQuest Asset Management. Laura, good to see you again. Good morning to you.
Good morning. How are you?
Fine, thank you. So I guess beginning with your take on that bearish sell-off that we saw, and whether you think, and the subsequent recovery as well. How have you been interpreting things?
Yeah, I mean, I think the sell-off was probably overdone. And I think that's why we saw the recovery on Monday. So we had that sell-off really for the last 3 days of last week, coming into the month of August. Driven by the weak data, in particular the US unemployment coming in at 4.3%. And then you add that to the non-farm payrolls numbers as well. So you can understand why markets took that quite negatively. But I think after having the sell-offs on sort of Wednesday, Thursday, Friday, people sort of took a breath over the weekend and came in on Monday and said, actually, it's not that bad.
Yeah.
Because the only real data that has been so negative for the US has been that unemployment data. And we all know the Fed has been watching that number in particular and has said very, very clearly that if that number weakens materially, they're on standby to react, to cut rates as needed to support the economy. So I think people sort of remembered that, to be honest, if we have weak data that leads to the rate cuts that we've been asking for since the start of the year, that's actually positive for risk assets. So I think markets just figured that out on Monday and thought maybe we
overreacted a little bit. Maybe we took it a little too far. All right. The asset classes, since you're talking about risk assets, where does one, how would you rank them from equities to fixed income, gold, crypto? Where would one park their money?
From a risk perspective, right? So safe haven.
Right.
I mean, I think, so when you think about the safe haven assets, people often think about places like gold. They talk about currencies, in particular the dollar, the yen, Swiss franc. They talk about government debts. In particular, I guess you would think of US Treasuries as a safe haven. You can even talk about defensive equities as another safe haven, and you can think about crypto. If I was going to rank them, I would say, especially in a market like this where we are, something like crypto is probably more risk asset type of safe haven than anything else. So I'm not sure you would, get any shelter there. I think government bonds have also proven to be quite volatile because they're really linked to a lot of the Fed action or Bank of Japan action that we've seen recently. So, I'm thinking government bonds probably not the place.
Yeah.
Defensive equities are probably, maybe, but I don't know that you will see, especially with the sell-offs we've seen recently. I think all equities sort of fell indiscriminately. I would say that looking historically, maybe the places that you'd find safe havens are probably in cash, in currencies. So I would have said the yen because that's been a strong sort of safe haven over the years. But obviously more recently with the Bank of Japan focused on trying to reflate the economy and without spooking the rest of the world, I think the yen has sort of suffered in that. So I'd probably say the US dollar, maybe to an extent the Swiss franc are probably places that you can just hold in cash. And I think I heard your segment a couple of days ago, was it yesterday, where you talked about Berkshire Hathaway holding a lot of cash.
Right, and building a cash pile,
Exactly. So perhaps even they recognize that I think the US dollar cash is probably the one place that is a real haven, especially in the kind of volatility we're seeing currently.
Now, I want to get your take on the criticism that Mr. Powell has come under since that big drop, since the sell-off, saying he's behind the curve, he's too slow, and everybody's now telling him what to do, saying he should cut by 50, 25 basis points. Well, what is the criticism fair? What do you make of what's been coming out from there?
Yeah, I mean, I think so. To be fair, there's a good argument that he's behind the curve.
Yeah.
If you look at the global central banks that you'll track, I think the Bank of Canada's probably cut twice. Recently, we've had the EU Central Bank cut, we've had the ECB cut, we've had the UK Bank of England cut. I think we've had cuts from like the Swiss Central Bank, even like the Swedish. So a number of European central banks have cut. So we've started seeing those cuts happening globally. So the Fed is probably the sort of last holdout. So I think that's where a lot of the criticism comes from. The Fed has said they're very data dependent. And as I've said, apart from that sort of unemployment data point that has been weak, I don't think the Fed has really been as slow as markets will say. I don't think a recession in the US is imminent. When you look at, this morning, this sort of US employment numbers were a key discussion point at our morning conversation.
Oh, really?
Yeah,
okay.
And our analysts had some really interesting points about the US. Data on the job side that makes it seem it's not as bad. So obviously we know about Hurricane Beryl in the US. And when you look at that jobs data, there was, I think, about 1 million people who were out of work because of the weather. Or who said that their job loss was temporary. So that's also, that's seen as sort of more transient than perhaps permanent job loss. She also spoke about the fact, so this is our analyst now, spoke about the fact that construction jobs as well in the US, when you look at that jobs data, that was one segment that continued to grow. And construction is actually quite a leading indicator for where the US economy is going. So you're still seeing jobs in those areas.
Yeah.
She's talked about the US PMIs, services PMI. So that came in, I think that rebounded to about 52 in July. But more importantly, the employment indicator actually rebounded for the first time since January of this year. It's been in contraction territory the whole time.
That's a really good point.
Yes, and it moved to 51.1 for the month of July. So again, speaking to the fact that, yes, it's true that the market is weakening, the labor market is weakening, but it's not as sort of doom and gloom as I guess the markets would have you believe. And I think that's also part of why we saw that recovery yesterday. People sort of thinking it's not that bad. And we've had a number of Fed governors, I think, from San Francisco, Chicago, come out as well to speak about the fact that, yes, we see the jobs data. Yes, we see that it's weakening. Yes, it's the signal that we've been looking for. And so I think it's now we're at the point where we all expect that Fed rate cut in September. I don't know that we'd see 50. Maybe we would. Maybe we'd see just 25. But I don't think a recession is imminent. I think the slowdown we've all been asking for is clearly happening. And so the Fed will react. And all will be well. All
right. Well, I like the take. Airbnb, should we use bookings for rooms? There's the Olympics going on and like the summer period. How would you interpret them, I guess, coming in under estimates and the stock just tanking about 14%? What do you make of what we saw there?
So I'm not even sure I necessarily think the results were so bad.
Yeah, right.
To be honest, I think they released their results on a bad day. So there was just a lot of market negativity. And so when their results came out, perhaps markets added to the general feeling of negativity. So I'm looking at the results on the screen, 2.7 revs, 11% year on year. Not that bad. I know that the EPS missed. I think estimates were for like 92 cents and it came in at 86 cents.
Yeah.
So EPS did miss. But when you look at the data or look at their statement, I think there were good and bad points. So on the bad side, they did talk about the fact that the US bookings are a lot lower expected, as we've talked about. They talked about the fact that we're also having some challenges with people booking with shorter lead times.
Yeah.
So shorter lead times meaning that they're not as confident about the future anymore. So they're not booking holidays sort of 6 months, 8 months in advance.
Gotcha.
It's now happening. So there's clearly that issue. But they spoke about very good growth as well in developing markets. So they said, LATAM is very strong for them. Asia Pac is very strong for them.
Yeah.
They also talked about the fact that they are also improving their room quality. They've closed out a number of low quality bookings. So you can see that it's not as bad as there's growth coming from the rest of the world, even though US growth is weakening. So I don't think it's that negative. But if you're looking for indicators from a corporate perspective that US earnings are weakening, I'd also point you to, US consumer is weakening, I'd point you to McDonald's as well, because McDonald's also released their results, Q2, and I think their same-store sales fell 1% in Q2, which is the first fall since Q4 of 2020, which was obviously the pandemic year. So that's a clear, and they did say very clearly that, a big portion of the issue was people are not sort of spending on those, as much. So there's a clear consumer issue, which we've all talked about, that the Fed is aware and the Fed will react in September. So all is well.
So you see, you talk about the consumer. Disney is choosing now maybe mid-October, to raise streaming prices. What do you make of the impact of streaming on, I guess, TV? Network television and then cinemas and so on?
Don't we all love streaming? I think I've forgotten what TV was like when you had to sort of wait for a show to come out. In particular, I'm waiting for 8 o'clock to watch my show. That's all gone now. So I think TV has changed fundamentally. And I guess to my mind, I'd say streaming services are now beginning to price themselves rightly. I think when Netflix was trying to penetrate, it probably came at a very low price point, just to try to build that value, for customers to understand the value, and for them to see why watching TV the traditional way, or sort of going to the cinema and all those things, are not the future, and why that convenience, flexibility, variety that you get with streaming was the future. Now they've built that loyalty. People understand that, and I think we saw a move to streaming that was much faster than I think even they were expecting, as Netflix or Disney or Hulu or whoever it is. Now that that's happened, and that demand is a bit more inelastic, I think these companies are now taking advantage and trying to become sustainably profitable. Because on the other hand, what that has meant is the demand for content has probably moved up quite a bit. So I would imagine that demand for shows, the price you pay for content, has probably gone up quite a bit, because the likes of Netflix, Disney are all trying to get ever new and ever more content to fill up their streaming services. And that obviously means a lot of costs. And so they make up for that by
raising prices,
clamping down on password sharing, because I think the future of TV is now this convenient TV, and it's no longer waiting till 8 p.m. to catch your show, or till 9 p.m. I think that's sort of a dying, maybe sports is probably the one place that might still be the thing. Hey,
Laura, it's always a pleasure having you on the show to talk markets. We'll see whether the bears keep chasing investors or they can escape, and whether or not markets continue to stay positive.
We'll be fine.
Laura Fisayo-Kolawole, head of course, Equities, Alternative Asset Solutions, FBNQuest. Thank you so much for your time. Really appreciate it.
Thank you.